Yeah, I can do that.
Cheers. C'est très intéressant aussi à voir. Oui. Mais la prochaine fois.
Okay. So let's move back on the second part of this public hearing. Focus on more the work like ESMA is doing in the area of short-termism and the corporate reporting, and we are starting with the short-termism.
Thank you very much, Oksana. So I will briefly take you through the work we are going to do on short-termism. First of all, my name is Christian Winkler. I'm heading we call the Markets and Investors team in our Risk Analysis and Economics unit. So this is an economic analysis team, which may also give you already a slight hint that the focus of the work on short-termism is a bit different to what we have been discussing so far today. So there's more focus on collecting and analyzing economic evidence, and only in the second step we are talking about kind of is regulation effective and what policy conclusions there might be. Sorry, one thing which is very sustainable with me at the moment is my cold, so my voice might go from time to time while I'm speaking. Also, you have seen this slide before in Matthias and Kian's presentation. So the work on short-termism is linked to item 10 of the action plan, which has been published in March 2018. And there you have the action 10 is about fostering sustainable corporate governance and attenuating short-termism in capital markets. There are three things I wanted to say here. One are the timelines of this work. The second bit is how does this work across ESAs. And the third thing then we're going to talk about is a bit the content of this thing, of the work. And there also I will be very much in listening mode today. I will probably ask you more questions than already trying to provide you answers in which direction we are going, because the work we are doing is only really about to start, because we haven't received the call for technical advice by the Commission yet. So this is the first thing then I want to talk about is timings, because what you have seen in the Financial and Sustainable Finance Action Plan was that the ESAs were expected to deliver advice work on short-termism by the end of this quarter. Now, this has been shifted back, and we are only about to receive the call for advice by the European Commission. So we expect this to happen until the end of this year, beginning of next year. So we're really only about to start this work. Second, this item of the action plan refers to all of the ESAs. So this will be a call for advice, which will be issued also to the EBA and Europa, where we will be looking at issues around short-termism in our respective mandates. Now, in the action plan, the Commission has been a bit more specific for ESMA, what they want us to look at, and this is where we already have clarity. And these are the two items listed here, where I will come back in a bit more detail in a second. The first bit is about portfolio turnover and equity holding periods by asset managers. And the second bit is in a more generic term, whether there are any practices in capital markets that can create short-term pressure in the real economy. Now, let me take the second item first. So here, about the drivers of short-termism. Here the ESMA task is to collect evidence whether there are any practices in capital markets that generate undue short-term pressure in the real economy. And I would like to ask a few questions to gather your views on this issue. So, questions to you are, which drivers of short-termism do you see within ESMA's remit? So, for example, in the areas of asset management or corporate reporting. Importantly, also whether you can suggest any quantitative or qualitative evidence which we could look at and which we could use to assess whether these drivers are significant. Now, the second area we are going to look at in more detail in our short-termism work is portfolio turnover equity holding periods of asset managers. And here, the task which has been given to us in the action plan is to collect evidence about portfolio turnover and equity holding periods by asset managers. And again, two questions to you. They are basically similar. So the first question is, which data sources, on top of commercial data sources such as Morningstar or the recent study by 2Degree Investing Initiative, can you suggest? And also here a bit of background. When we look at commercial data sources such as Morningstar, what we see is that the data available on portfolio turnover is by funds basically fizzling out after the reporting requirement on portfolio turnover has been repealed in UCITS. So there has been quite good coverage up to 2010, 2011, and since then the data has been fizzling out. And if you want to do a longer term analysis, you cover only a very small proportion of funds. So anything you could do with kind of Morningstar, for example, would only give a very partial picture of what's going on in the industry. So in that sense, like it's a second question whether you can also suggest quantitative or qualitative evidence for us to look at, where we can assess how changes in portfolio are linked also to short-term or longer-term investment strategies by asset managers. No, the floor is yours.
Okay, so opening the floor.
Hello. Does it work? Yes. Okay. So Stan Dupre, 2Degree Investing Initiative. Just to answer your first question, I think so. The studies have not been done with like publicly available databases like Morningstar or Thomson Reuters. You actually need to get access to more granular data on portfolio transaction. Our understanding is like, and I don't know to what extent it's compatible with the approach you want to use, but it's the next step we envision in the project was to partner with large asset managers to get access to their like books basically and study that. And so this can provide additional information. The other aspect would be we figured out that there were no kind of back testing on what would be an optimal turnover for a given investment strategy, which will require to develop an algorithm to kind of test that. That's a possible next step, and I know that asset managers are interested to get involved in this type of approach. And I think if you engage with them, they will probably accept to do that somehow. The other aspect to answer your question on the second question, I think what would be interesting to look at is to what extent there is explicit, like what is the kind of time horizon when asset manager commission research, like so on the sell side or even in-house research, because in the context of this study we try to see if the short turnover, the high turnover was also related to a kind of focus on the short term for research, and that was the conclusion. And we basically did not find any evidence of appetite for long-term focused research. And now that like the sell side are supposed to sell their research, I think it's easier to collect evidence on this topic.
Just a quick reaction. So thank you very much for this very useful comments. And indeed, I think one thing we are going to do is also within kind of our stakeholder groups in ESMA, be it kind of the overall Securities, the overall SMSG, or kind of also from the more analytical side, the group of economic advisors where we have members from the asset management industry, and indeed we also wanted we'll be going to reach out to them and try to do kind of more detailed work on the things that kind of how does turnover look like, what do they see as kind of an optimal turnover. So that was one of the ideas, and I'm glad that we are thinking along the same lines here.
Petit, the SHIP project. One anecdote first. If you read the report by the ESAs in April last year, they use the word lower carbon. It's a lower carbon economy. You should remove, it's a mistake. It's a low carbon. I hope one day it will be lower, but it has to be low, close to zero. And it says a lot about the misunderstanding by ESAs, ESMAs, AOTAs and ABAs about the issue. One point I like to stress is the link between index. The index is closely linked to long-term objectives. Well, I don't know if it's an objective, but a trend. It's linked to a 4 degrees or 5 degrees world. So I would suggest ESMA to have much more look about the indexes. What are the trajectories and scenarios, underneath scenarios for these indexes? What do they lead? I would ask ESMA to look at passive investment. What does it mean? This huge trend toward low-cost investment. I'm not here to defend active asset management, but we have now a huge wave of passive asset management with no intelligence at all about what's going on and where we want to go. So I would like to ask ESMA to look at this trend. What are all these index going to? What is this passive investment going to, which is more than short-term, it's just blind investment. And I would ask the rulers in Europe and the Commission to try to prohibit passive asset management, which is for me a plague.
Hello, I have a very general question. Are you differentiating between short-termism and short-term finance? Because I do think they're different things. And what is the scope of the work? Because right now I understand there is a focus on you want to know more about asset management, but are you also looking at other players? Because of course a short-term strategy, trading strategy can be contributing to a long-term and sustainable goal. Yeah.
Sorry, can I just ask a clarificatory question? What do you mean exactly with other players?
Are you looking at market makers, for example, who are basically there to hold very short positions in the market, or is it really just on the present?
So you.
I think I would like to say a lot about the scope of this topic. My view would be more about the scope of the direct investment of consumers. I think what's quite interesting in France, for instance, is what you see in the percentage of livret A, that is to say very short-term, non-risky saving schemes compared to the rest, and the fact that retail investors decide to reduce their amount, their share of long-term investment compared to what is seen as really the ability to have a significant amount of their savings in very short-term deposits. So in terms of scope, I think what is important in my view is to include also the decisions taken directly by consumers, rather than, I would say, market makers, because market makers are not investors. They are here to provide market liquidity. invest. And so I think that typically if you have in mind the prohibition of prop trading, there are clearly some aspects relating to the fact that in principle market makers should not hold positions for a long time. So we need to be really specific on what we are aiming to look at. But in my view, the role of market maker is not to invest, it should be out of scope.
Let me start from the end. So the scope, I think there, first of all, we don't have the don't have the final mandate by the Commission yet on the scope of the technical advice. Now, first of all, like on the investment of consumers, yes. So there's also the question about kind of are these long-term investments or not. But even like if you look at the livret A, like even if it's a very kind of the nature of the investment is kind of a short-term thing, it can have still very long holding periods. So that's and that simply has to do with kind of the tax incentives, because it's the most tax it's a tax-efficient way of saving. Anyhow, that's so there we would need analysis about this, but this is not in the ESMA remit because the deposit would be in the EBA remit. So this leads me to the second point is. We very, in terms of scope, we have to focus on what is within ESMA's remit. And there are very much the two main areas where kind of we're probably going to look at are the asset management space and is the corporate reporting side. Like then it's a very good question about what is happening on the trading side as such. Because obviously, like this is a very short-term business, market making, prop trading, frequency trading. Now, the question is there a link of this short-term, very short-term activity on kind of whether this is an impact on kind of short-term or long-term investment behavior? And this is something which would need to be established, where we might look at, we'll probably look at whether there's something in the academic literature. But would really need to, you would really need to establish a link between that short-term activity and what is going on really with kind of short-termism, which is an impact on the real economy. And that link, to my mind, is not that straightforward. So.
At least we agree for service.
This is Gail from Investor. I mean, a similar point around scope, particularly in the slide that's currently up there about just looking at portfolio turnover by asset managers rather than looking at investors more broadly. I mean, obviously, for an asset manager, there'll be two drivers in terms of your portfolio turnover. One will be your own decisions to sell, but the other one will be redemption, and that's not within our power. That's the decision by the end client. So I think being able to look at this at a client level and see some of those underlying drivers of what's driving that turnover, I think will be really important in terms of understanding the broader market dynamics that are going on. And if you just look at the asset manager level and you look at the aggregate level, I think you'll be missing things like that right now, which is understanding what the underlying drivers are.
Any other comments or suggestions?
Thank you. Maybe a broader comment. When we started to work on this topic, one of our findings is that there's actually very limited resources globally like dedicated to this topic of the lack of long-termism of investors and the link with financial regulation. And I think if given the ambition of the Action 10 of the Action Plan, I understand that supervisors and the Commission are don't have like teams dedicated to that, don't necessarily have the research capacity to develop that. So one suggestion would be to try to develop partnership with the research, with academia and research, to be able to like investigate this topic further, because 6 months obviously you won't solve the problem and you won't get enough evidence. and there's a lot of ramification. And so the same way like central banks are starting to partner with universities to work on green finance, I think there's probably an opportunity to do it here. And one short-term option is like we are organizing on the 4th of April a conference that will be hosted by MEPs on this topic, reviewing evidence, and we will try to invite all the researchers that produce evidence in this space. So you're welcome to coordinate with us on the organization. It will be in Brussels.
One more comment on regulation and long-term vision. If you look at Solvency II, for instance, which is a good example of financial regulation, my opinion is that in France it costs around 1 billion euros to implement this regulation for life insurance companies. Around 1 billion, maybe more. But it's, I think this is the order of magnitude of what it costs. In-house expertise and outside expertise from consultants. In, I would say, 8 years, 8 or 10 years. Everybody knows the impact of Solvency II rules, which is quite short-termism. We are going to change it in 2 years from now. I hope it's changed for much more longer-term vision. But the first implementation was quite short-termist. I was wondering how much money was spent in life insurance company in France to implement the Article 173. That would say 10 million. So we are another magnitude of 1 or 100. So what do you intend to do to improve the means that will be used in the financial community, the expertise we need to tackle this huge challenge of climate change?
Maybe on this point, because I think also earlier today you mentioned about resources and all that, and I think I mentioned to a few people that I think we are all a bit in a learning stage. We are just building the first bricks now, and it's not obvious. And even you said there are different people, as you can see in ESMA, touching on the topic, but obviously the building the knowledge and trying to come up with something which is very coherent, it will take probably a bit of time, and obviously a collective effort from all sides, and that's why we invited you here today. But maybe also makes us think about, linked to your proposal also, clearly it's a bit difficult for us today. We put only these 2 questions to you because we don't have a very clear mandate, so we don't know exactly what the Commission will be willing to cover. So, you know, we have a bit of exploratory ideas, but we can't be very precise at this stage. But perhaps once we have more clarity on that, I think we'd probably have a similar consultation paper or something like that in which we'll try to get also your views on this topic. Any final comments or questions? Yeah.
Based on the literature, what distinguishes short-termism from long-termism is the fact that the investors act on long-term information. So it's not really the old inferior. So the fact that the decision to sell is based on a long-term analysis and not based just on short-term announcements. So I think it would be probably good to create this link with the information piece that is what drives the decision. It's very difficult to capture, but probably as I said before, it's a link also with the research that is available and the analysis provided.
Quick response, I agree. Because if you think about it, like if you just look at kind of a equity holding period or portfolio turnover, this is just a number. And Stan made a very good point, is what is kind of an optimal turnover for a given strategy, investment strategy, and this is something where I think kind of a bit more deeper dive is needed. How much we can advance this debate in kind of a short kind of call for advice, advice to the Commission is a different question, but indeed, like this I agree very much on this, and that's is kind of then that investment decisions are based on long-term information rather than short-term information, then the question is, what impact does this have on your portfolio turnover? And that is not at all clear, in fact, because it can lead to quite significant shifts in your portfolio as well.
Maybe just, I think one other aspect that is actually also in your remit is the link with corporate reporting, because we reviewed in another study the reporting of MSCI World companies, and to what extent there's any discussion forward-looking and like data, and discussion of long-term risk, which means risk that are likely to materialize after this usual 3-year period that analysts focus on. And I mean, the results are pretty impressive. There's really nothing on the long term, especially in the risk section and management discussion. Even when some risks are acknowledged as like major factor of disruption, there is no discussion. And so, for instance, if you take the finance sector in this in the MSCI world, like the disruption related to automation, artificial intelligence is acknowledged like widely as one of the main factor in the next decades, and there is not a single financial institution that actually discusses this topic in their risk section in the MSCI World companies. So I think this is something that also requires some type of investigation, and the fact that there is no requirements on this topic, or at least they are not interpreted this way and they are not enforced, is probably something that is to consider.
Can you hear me?
Yeah.
Yes. Right. From the French Asset Management Association. Just one question. I was looking at this subject and trying to see what it covers. When you look for short-termism, you also think liquidity. It's a bit weird to see that you ask us to see how we can focus on the job of the asset manager regarding short-termism, and in the same time, ESMA is working on liquidity stress tests for all types of funds, UCITS and IAFs. So there's a bit of a link which is not done between those things.
Thank you very much. On the last comment, I think there are two things here, like a liquidity stress test. I don't think there's an immediate link to short-termism or not, because what a stress test is about really is a fund able to sustain an external shock, and that will for funds be a redemption shock, and will they be able to deal with kind of large outflows in a quite short time period. And that is something actually in the first instance has nothing to do or little to do with the question around long-term investment strategies. In fact, like so we'll pick up on this argument, but that will be my immediate, and I will put a bit more reflection on this, and I think we will pick up on this argument and take it back to the colleagues when we're doing the work. But this will be my immediate reflection on this. We are talking about different things here. Like liquidity stress test is really about being able to react to an external shock. And if you talk about shock, there's something which is generally happening quite quickly. It will be obviously then a short-term reaction by the fund is needed.
And perhaps more general, I think the idea is not, we shouldn't say probably as necessarily as a conflict between liquidity and long-term investment. So I think it's where we need to have probably the proper level for each of the both things. That was the last comment already.
No, you know, I mean, on this question of liquidity, I do understand the answer, Christian, about the systemic aspect of the subject. There is also a sort of angle of analysis of